Welcome to the Twomey Stock Market Report. I'm James Twomey, and today's Sunday, January 15th. And as you know, we have now posted live our weekly stock market report and trades. That's at the number 2 mestocks.com. Go view it now and get all the latest and greatest information. But back to our story. What's going on with the stock market and what is the market analysis? Here's a brief summary. Well, this week we saw a tremendous increase in all sectors, all of the indexes, and it has certainly raced off, mostly due to the release of the CPI data and Friday's earnings release. What did the CPI data tell us? They said, well, inflation, yes, it's still here, but month over month, or it has abated a bit in the strength of its increase. So we're running in at about 6.5% inflation. It's been the smallest 12-month increase since October 21st. All items, food and energy, and index rose 5.7% over the past 12 months. So what is that telling us? The traders celebrated and said, oh, inflation is slowing down, and we're not going to have the Fed's pressure to keep raising rates, and everybody piled into the market. The short story there is simply this. Traders and investors are trying to time the market, and they're looking 6 months out, and they're thinking that the Fed is either going to reduce the amount of rate increase, stop rate increases, or maybe even pivot. The bottom line is 6.5% inflation still puts tremendous pressure on companies because wages, as long as employment stays high, which it has been, people will continue to jump jobs if they're available and try to get higher prices in their salaries. It also costs more for the companies to buy supplies and goods, and it also costs more for companies on benefits. Hence, inflation continues, prices stay high, and that puts a drag on the economy. So more to come. We're treating this rally as the beginning of a bear market rally. You have to be very, very careful. We've taken advantage of it. We've jumped into a variety of different sectors. We've alerted our subscribers of these trades, and you can get those at the website if you visit it now at the number 2 mestocks.com, where you can see all that information. So basically, what's going on? The whole country is. A Gallup poll came out. They're predicting tremendous pessimism for the economy. Really, after last year's inflation, we expect that, right? But the biggest thing is the lag factor. Really, the interest rates that have been increasing all last year. The economy doesn't. It takes 6 to 9 months for the economy to register those, and for them to start taking effect. When you have high inflation numbers like we do, we were up in 7, 8, 9%. It takes quite a bit of time because we're only working the demand side. And what do we mean by that? We're only saying, hey, we're going to make money more expensive to borrow, and we're going to try to make you borrow less or not borrow as often, since you have to now pay a higher rate for that. You have to make sure your return on investment, etc. Right? So we're not changing anything on the stimulus side. More on that later. But what's happening is, if we look 6 months ago, we're really just feeling the effects of the June 16th, 2022 rate increase of 0.75, and maybe July. Well, what was the federal fund rates at after that hike? 1.5 to 1.75. In July, it was 2.25 to 2.5. We're now at 4.25 to 4.5. So really, we got a couple of 3 percentage points to really feel before and how before the full brunt of this raise of rates. That's going to tell us something, because when we start feeling that, if the economy's slowing down now, it's really going to slow down when you add 3 more percentage points into that. In addition to that, we're going to raise rates in February. How much? It's 0.25 to 0.5. Whatever that shakes out to be, it's going to be a continued drain on the economy. So what's the conclusion there? history has shown us that when we only work on the demand side, rates only, it leads to poor stock market returns. Excess stimulus, which the government is pumping into the economy, into these stimulus bills, is further inflationary when unemployment's low, and we still have unemployment at low levels. So we've got that tug of war going on. The pundits and the investments community is saying, oh, inflation is easing, the Fed's gone too far too fast, and they're jumping into the market. And then all of a sudden, some negative news comes out, or bad earnings, or something comes forth, and we have a 5 to 10% whoosh drop in 2 days. So that's why we have to protect ourselves. If we look at the overall trend of the market, and we use the SPI for that, you could see for the past year, it's still very much within this red down trend track line, the Twomey trend track line. And in addition to that, we're starting to see another push above that upper trend line. Every time we did hit or push through that trend line, we had a tremendous sell-off. Well, the last one that happened in early December, the sell-off didn't come down and retest the lows. It flattened out. And of course, we expected that because towards the last couple of weeks of the year, there's less trading, less volatility, less volume of trading. Yeah, there can be volatility, but overall, the fund managers really kind of position themselves to end the year, and then they set up for the following year. We opened up this year, the markets, raced up the last 2 weeks. We're up abutting that trend line. Interesting that we didn't retest the lows. So what are we on the watch for? We're on the watch for two things. Are we going to stay above and break this trend line, or are we going to retreat and retest the lows again? So you got to be very careful in these bear market rallies. They can be very painful. Short-term indicators on the SPY, they're all positive. The long-term indicators, we're bumping up against the 200 EMI, which is a technical indicator, and that has been, if you look at this heavy blue line, prices get there and they get repelled. Very interesting week ahead. Very interesting week ahead. So we get a further look, and you can go into the market report because I want to cover some other things, but it goes into the stochastics and MACD. Those are our oscillators and trend changes. The stochastics we use for a short-term predictor. We don't trade off of that. MACD, we look at a more longer-term view. And if you look at the MACD, it has not crossed into positive territory. The last time it was in February 21, 2022. We're still in negative territory. It's getting better, but we're still here's the MACD, the negative territory below zero. So we've got a lot of work to do. We need that to get over the zero to show a longer term trend on the upward side. We're not getting that. The Dow Jones, that is another, the diamonds we use as a proxy for that. That has done several things. It's been above the 50 and the 200 EMA, and it's holding there. It's above all our short-term indicators. In addition to that, the EMA and also the smoothing averages, the 200 has crossed, the 50 has crossed above the 200. It has not been really recognized out there. Really, the SPY has to do that for the pundits to really say, hey, it's a positive indication that we're going to have a longer term trend up. But that stayed, there's remained there for quite some time, since the early end of November. That's a very positive indicator. People are parking their money into the Dow Jones as a place to look for either dividends or potential growth. If that slows down, it'll mean that money's going into more riskier sectors like the NASDAQ and the small caps. We've seen it in the small caps. The NASDAQ's starting to rise, so we're going to see. This is a very, very interesting week ahead. Typically, mid-month, things do pull back, but, and we are right at mid-month level. Let's see, what else do we want to talk about? Some couple of things. We also go into, in the market report, all the environmental analysis. What is that? It's how is it economic changes by either the government or the Fed, or worldwide like the war in Ukraine or supply chain issues, how that affects the market and certain key indicators. So we bring up several items there on a weekly basis for you to review. We also go into the bond ETF market, which we are, heavily invested in over the year. We had some spectacular bond ETF gains last year in the 35 to 48%. We've changed from short and long on that. Very, very positive trades for us the past year. We go over the sector. The sector, where's the money flowing? We look at the major sectors. I use this to see where the money's gone the past year, the past 6 months, and then we report on the past month to give you that short-term trend where should we put our monies. And if you look in the past month, 30 days, it has been, financial materials, consumer discretionary are leading the charge. Down below, healthcare and information technology and utilities are at the bottom. So we've got a really robust positive green for the past 30 days. And interesting, where the money is flowing right now. And we're pretty much, we're in financials, we're in materials, we're in communications, we're also in energy and industrials and real estate. So we're in those top sectors. We're going to watch those closely. And we certainly know over the 6 months, we're starting to see positive performance in some of these, which is really, really exciting. We also look at the relative strength index. What is that telling us? There's two things going on right now. The Dow Jones, or the diamonds, it's up around 62.5. It was 54 last week. So we're getting closer to the overbought area, right? We internally here at the Twomey Stock Market Report view 65 as the beginning of overbought territory. Usually 70 is the number. But as we get towards that mid 60s, we start tightening our stops because by then we've had some huge gains. The difference is the RSI is swinging 10 to 15 points within a week. And that is, anytime you see a very fast volatility in the market, it usually is not a good sign. It means there's pressure on the market and it could be a good sell-off in the up ahead. However, we're not quite there yet. All our numbers are showing the NASDAQ and the diamonds and the SPY have room to grow as far as RSI getting higher and higher prices therefore. We look at the advanced decline chart. Do we look at this as a longer term trend? What's interesting here, we've crossed well above the 50, well above the 200 EMAs. Last time we did that was early, August. And we didn't stay there very long, a couple of weeks, and then it, retested the lows. This is the advanced decline. Looks at the New York Stock Exchange, and it maps out advances over declines, and it comes up with a ratio. And I put it in a line here for our graph so that we can view. So we've got an upward trend. The RSI here is at 72, overbought. That's telling, and this is a longer term view of the trend for the market. So to have a 72, that's a little high. The last time we were up in these numbers, we had an immediate cascade down and retested the lows. So we are on watch. That is very surprising. I would have expected that to be a little bit flatter. What that tells us, we had a dramatic increase. And if you look at the number of stocks trading above their 200 moving average, it's now almost 62%. Last week it was 51%. All last year we were below 50%. And we got a low, I believe, where 80% of our stocks are trading below the 200 EMA. So we've got a lot of positive data in this chart. That's telling us the breadth of the market. More stocks are participating in this rally. We're treating it as a bear market rally. Very important information. So again, it's 21 pages. I know I could get it in exhaustive, but over the week, take excerpts, read it, reread it. You'll get a feel for the trend of the market. We want to trade the trend, not become a reactive trader. We do have our trade tracker in there. We're long the TLT. We're also long 200% version of that. We've got a couple of percent gain there. We're also long the small caps. We got a big bump this week in 3% in a very short term trade. We also a couple of dividend plays. Verizon is running about 6.3%, so we're trading that. We did get out of our Coca-Cola. That's that has took a downturn, and we're not going to wait around for that. We're trying to get another dividend play. We did get into NLY Capital Management. NLY pays a dividend of 15.9%. I want to show you something here. NLY, and we're going to come back to another. If you look at this on our charts, okay, that's the daily chart. So we've had a nice run up from a low. If we look at the weekly chart, see here between March of 2020 and all the way before we had this major downturn, which started for everybody in March and February of 2022, you had a very, the trading range of 24 to, let's say a high of 39. So if you got in around the middle there, let's say 28, 27, and you get 15%, it protects you. I mean, if it drops 10%, you're going to go from 27 to 25, and you're still going to get a 6% return. It obviously is sensitive to the downturn in the market and this is why I'm showing you the weekly chart, because look at when we hit the bear market in February, March, it dropped. So we have to be careful. But we're looking at this if the market is going to flatten out the next 3 to 6 months. We expect this also to flatten out the next 3 to 6 months. And if we can get 6 months, that means we're going to get 7% dividend. And if the stock doesn't really change from our entry, I'll take 7% over 6 months for a trade at any time. So this is one you could park a lot of money into it and then watch it. And of course, if you sign up for our alerts, you'll know when to trade it. The other one is PAA. We've been in and out of that with some stellar gains, and we got back into that. That's another dividend play. That one's about 7.5% now. And if we look at PAA, it's a pipeline. It's Plains All American Pipeline. I'm going to go to the weekly chart again for that. Here we go all the way back to March of 2022 when it was down. And then it popped up in the mid-year of 2020, excuse me, not 2022. And you see it's traded pretty much flat between 8.5 and 13. And you get, so if we try to get in, and it's been a little bit higher than we wanted to get in, but if you get in around 11 and you got a 7 or 10, let's call it 10% just to make it math easy. 10% from 11, you could go down to 10, 9.5, 10, and you're still going to, break even. And if it rises, all the better. So what we're trying to see here over a period of time, again, if we got in a little, 11.89. I'd like to get in around 10.5 or 11. It hasn't reached that, and we may add to it. But overall, last year we didn't even, we were in and out of it most of the year. We were getting gains of 13, 15% just on the stock market gain alone. Plus we were getting our 5, 6% interest. So we're back in that. We're going to see how that plays out. We also took some very slow movers like Goodyear, Borg Warner. Borg Warner's up 5.5%. We don't expect these to rise a lot. And part of this is every time the market has these major downturns, you get flushed out and you can lose 10-15%. So if you look at Goodyear, let's go back to 2022. We had a high of 23, and all last year, of course, it got killed in the bear market. And what do? We end up hitting a couple of lows at 9.9. So now, if the market's taking off, what are we seeing? We're going to get a bounce off the lows, and will it extend back up to the 200 EMA? It's almost there now, and will it reach the last high of mid-August, which is 15? So this has the potential to run. It has a small PE. Forward PE is 8.16. It's got good sales. People are keeping their cars longer. Infrastructure plays are taking off, and we're going to see a tremendous amount of money going into that sector. All right, so we also get into some other areas. You can pull up the trade track. We're in materials, we're in industrials, we're in financials. We added also a gold miner to that. That's 4.5%. The material sector is up almost 3.5%. The industrial sector, we're also in energy and not only PAE but XLE. Some vanilla ETFs, trying to stay into all those sectors we showed you. We added JP Morgan this week. That's up 5.9%. We'd like that, was a nice trade that we alerted subscribers to jump in quickly, because they reported earnings on Friday and things took a big hit for some reason. We had a nice buying opportunity to take advantage of. So that's pretty much where we are. I want to, have you join the TwomeyStocks.com at the number 2MEstocks.com. Take a look at it, get all this information. You can watch our videos, you can get our training. Very easy to access and on your own, and also you can sign up for alerts. I'm James Twomey. This is the Twomey Stock Market Report. Join us at the number 2MEstocks.com. Have a great week. Thank you.